with the S&P 500 and Nasdaq already down some 23% and 32%, respectively, from their record highs. Confirmation that the Dow is also in a bear market is just the latest milestone in 2022's market turmoil. Reasons behind Cathie Wood and Michael Burry opposing each other on the future of markets. We will also understand the stock positions of both Cathie Wood and Michael Burry and their comparison to their stance. Cathie Wood feels that the market will end its bearish runs, and the Fed will be surprised by it too. While Michael Burry thinks that things are world worse. Maybe it's too early. Just last week, the stock market experienced a roller coaster trip. The S&P 500 and the Nasdaq both hit new lows this year. There could be a lot more misery ahead. Michael Burry recently tweeted that more than 13% of stocks closed above their 200-day moving average. Only 2.8% of stocks closed above the norm during the market bottom in 2009, and only 1.2% of holidays closed above that average during the market bottom in 2020. So by those metrics, we're currently at levels last seen in December 2007. If you didn't invest during the Great Financial Crisis, the S&P 500 didn't reach bottom until 15 months later, in March 2009, after falling another 50%. As a result, we may still have a long way to go. For the record, we are not predicting another 50% crash in the stock market right now. We're merely pointing out that the most recent bounce may not signal the conclusion of the current bear market, because everything that's generating it hasn't gone away completely. The ongoing conflict between Russia and Ukraine, tensions between China and Taiwan, persisting supply chain concerns, and the impending winter increased demand for oil and gas. Everything concerning credit suites and credit default swaps. If you're not interested in global affairs, how about the combination of rising interest rates in the United States? And earnings for practically every U.S. state were lower than predicted. Tech company, particularly when compared to epidemic figures. But one individual is betting on the opposing side of this wager. Her name is Cathie Wood, and she believes that deflation is already affecting the economy as commodity prices fall. Inventories are piling up, and retailers are preparing to drop prices for their most significant holiday sales. She believes sheet is at the start of the pipeline. But at the end of the channel, we have overwhelming business inventories. According to her, we have a customer that isn't playing as much as they used to. So she believes this holiday season will be difficult and involve much discounting. She expects the Fed will be shocked by the deflationary pressures affecting headline inflation estimates in the next 3 to 6 months. So Cathie Wood basically answers the opposite of Michael Burry. She believes inflation will fall sharply when these deflationary pressures work their way into the PCE and CPI. When those price indexes begin to fall, the Fed will reverse course and stop aggressively hiking interest rates. Growth stocks benefit the most when this occurs because their market caps are priced longer into the future. Growth stocks, such as those in which Cathie Wood's and ARK funds exclusively invest. Whatever side you take, it's good to know what they've been purchasing and selling. Let's start with Michael Burry from the first quarter of this year. Michael Burry owned 11 stocks, including some household firms such as Apple, Google, and Meta platforms. Of course, these are the same corporations that dominate the indexes. But if he genuinely believed that the stock market would crash, wouldn't he sell all of his assets to protect himself? And his investors, well, that's precisely what he did by the end of the second quarter. Michael Burry literally sold every single one of his holdings, everything from Apple to Google to Meta platforms. He currently only has one job with the GEO group of private jail operators. The stock appears to be a bit of a mixed bag. GEO, for example, trades at almost 45% below. According to Wall Street's built-in discounted cash flow analysis, they've been determined to have fair value. However, GEO Group stock could be an excellent long-term investment. They also trade at a very reasonable forward price-to-earnings ratio compared to their peers and far lower than the industry average. The stock also includes a few large red flags. For example, their past return on equity, return on assets, and return on capital are all at or below average for their industry. Its financial health is also relatively poor. owing to many long-term obligations compared to assets. It also has a very high debt-to-equity ratio overall. Even if you believe Michael Burry is correct about the market, at least in the short run, we wouldn't rush out and get it right now. Our key aim is to demonstrate how serious he is about his prediction. It is severe enough to sell hundreds of millions of dollars in holdings in some of the world's top hit businesses. In contrast to Michael Burry's hedge fund, Scion Asset Management, which reports its holdings quarterly, we can see what Cathie Wood's ETFs over ARK are buying and selling daily because they say their holdings before each market open. Look at what equities Cathie Wood has been buying as she anticipates the Fed lowering interest rates. Sort the data by the change in share count to view this. Here's how Michael Burry's prediction might look on the other side. Cathie Wood's top 3 growth stocks include NVIDIA, UiPath, and Kinko Bioworks. Cathie's holdings of NVIDIA stock have nearly doubled in the last month. NVIDIA created some of the world's most powerful chips for graphics processing, data centers, supercomputers, and edge devices such as laptops and self-driving cars. Cathie is banking on GPUs and AI accelerators to replace traditional CPUs like those offered by Intel in enterprise data centers. NVIDIA's story isn't all roses and rainbows. Their stock price has been falling for the majority of the year, coming down by more than 50% year-to-date and more than 30% in the last few months alone. Last quarter, revenue from GPU sales decreased by 33% year-on-year and 44% quarter-on-quarter. That reduction is projected to continue since crypto miners not only ceased buying NVIDIA's GPUs after Ethereum was introduced a few weeks ago. The same user is already selling their own used graphics cards on the secondary market. As a result, NVIDIA's future sales are effectively undercut. 5 of the 6 simple Wall Street criteria are met by NVIDIA. It has high earnings relative to the savings rate and the rest of the market, growing solid earnings and healthy revenue. This is compared to the average company on the market and has a highly anticipated return on equity over the next 3 years. The one criterion they don't pass is substantial revenue growth shortly, owing to the reduction in GPU demand we outlined earlier. UiPath became public about 1.5 years ago and had been trending downward. The enterprise RPA market is only getting started and will continue to grow in the coming years. UiPath creates software robots that manage simple but repetitive workflows such as invoicing, email filtering, data gathering, entry, and formatting, which we all do at work daily. This stock appears to have some significant concerns. For one thing, UiPath seems to be trading substantially closer to its fair value, at least in terms of discounted cash flow. In addition, 19 analysts cover the stock, and their 12-month price objective has consistently declined from $76 per share to $17. They received 1 out of 6 on Wall Street's future growth checks because they are predicted to remain unprofitable for the next 3 years and provide. As a result, investors receive a return on equity. Kinko Bioworks creates microorganisms through genetic engineering for various industrial purposes. Their platform is divided into 2 parts: the code base of cells, enzymes, and genetic programs used to kickstart new initiatives, and the automated foundries, which are the physical labs and machines where these individual cells are manufactured at scale. Given its current cash flows, the stock trades at a discount of more than 40% to its fair value. Moreover, revenue is expected to increase by more than 30% annually, while the crew has increased by a stunning 305% in the last year. They also have a strong financial position, with more than $1.6 billion in assets and less than 1/10 in short-term liabilities. Oh, and there's no debt. They also have a healthy cash runway of more than 3 years, so they won't have to rely on higher interest rate loans. Wait before buying this stock, especially if you agree with Michael Burry's outlook for the market over the next 6 to 12, or perhaps 18 months. Kinko Bioworks is unlikely to be profitable in the next 3 years. The stock has also been quite volatile over the last 3 months, rising around 20% since the beginning of September. We recommend you put this one back on the watch list and wait for the volatility to bring in more favorable prices. Let us know in the comments who you agree with. We hope to see you soon with another video. But until then, goodbye.